The webinar is about to begin. Please stand by.
Good morning, good afternoon, and good evening to everyone tuning in to our Institute of Mergers, Acquisitions, and Alliances webinar. Today, we delve into the timely topic of how 2022 changed financial markets and business with Professor Aswath Damodaran. As we all know, the global financial landscape has undergone seismic shifts in the past year, with new challenges and opportunities emerging at a rapid pace. In his recent series and updates, Professor Damodaran has discussed a variety of topics, including a wake-up call for value investing, and highlights the continuing struggles of value investing, emphasizing the need for investors to adapt to changing market dynamics. The list of changing parameters like country risk, inflation, interest rates, geopolitical tensions, market volatility may continue to shape the financial landscape this year. Professor Damodaran has shaped the field of valuation and continues to make a significant impact in the finance world through his influential books, blogs, YouTube channel, sharing his expertise with audiences worldwide. The Institute for Mergers, Acquisitions, and Alliances is proud of our long-standing collaboration with him in executive education, and we're honored to learn from his vast experience and passion for finance today. Professor Damodaran is highly skeptical about mergers and acquisitions, and it is undeniable that achieving success through such inorganic growth strategies is challenging. We share this skepticism to a large extent. However, as an institute, we aid numerous professionals and organizations worldwide in refining their M&A strategies and processes, as well as enhancing their capabilities, ultimately increasing the likelihood of successful transactions. We're also thrilled to announce his upcoming virtual live valuation training in June. We appreciate this ongoing partnership with IMAA and invite you to stay until the end of this webinar for a special announcement about the upcoming event. Without further ado, please join me in welcoming our distinguished speaker to the live stage.
Thank you, Chris. Is my screen being shared now? Is it on? Oh, there you go. Okay, welcome, folks. It's good to see you. So I'm going to keep this informal. As many of you know, I spend the start of every year playing what I call Moneyball, which is just a fancy word for I look at what happened in the previous year, I look at the data, and I create all my data sets in that first week. So the start of 2023, I took a look at 2022, knowing fully well that this was not a normal year. Now, we can debate what 2022 was. At one level, you can say it was a break from the past, but that depends on how old you are. So if you're in your 30s, you're saying 2022 was an unusual year. But for those of us who are older, 2022 was really a return to normalcy. So the question that we face in 2023 is, will we go back to what we saw in the last decade? Or are we now in a steady state, which is more like what we used to see before 2008? So it's an interesting year, a lot to talk about. So let's get the show on the road. So I'm going to start off by making an obvious statement. Now, I talk about risk in all of my classes, but when times are good, people think of risk as an abstraction. It's not something they take seriously. And it's almost like you need reminders from markets about what risk actually is. So in 2019 or 2020, even after that brief interlude in 2020, there were a lot of people who were convinced that markets don't go down, they bounce back. And we got a wake-up call in 2022, a reminder that risk is always there, it never goes away, and that the more we think it's in the past, the more it's going to come up in the future. So what I'd like to do is take what I call an elevated tour of markets in 2022 and talk about the implications for investing, for corporate finance, for M&A, for whatever you're in. So to set the table, I'm going to start by looking at US equities, and we'll come back and look at global equities and fixed income later. But let's start with US equities. It's during 2022, I kept track every month of what the S&P 500 index was doing. And if you take a look at 2022, it was a year, and I'd like you to keep your eye on the numbers on a month-to-month basis. On a month-to-month basis, you had some awful months and some really good months. I mean, take a look at what happened in August of 2022. Returns on the index, the index was up 9%. So while we think of 2022 as a bad year, it wasn't all bad months. There were good months and bad months. The bad months obviously outnumbered the good months, but it was up and down. I'll come back and talk about why the volatility was so high and the culprit behind it. But clearly, it was a year of ups and downs. One month, everything was great. The next month, everything was awful. So I computed the return in 2022. And of course, the return on stocks comes from two places. It comes from dividends, but dividends are trivial, right? And then 2022, the dividend yield is 1.41%. The rest is price change, and if the index goes from 4766 to 3840, which is what the S&P 500 did, you don't need math to tell you it's a bad year. In fact, the overall price depreciation during the course of the year was 19.42%. The index lost 19.42%. You clawed back a little bit with the dividend yield, but it was a terrible year for stocks. The return on stocks was minus 18%. Now, I like to always put things in perspective. And I have a database that goes back to 1928 where I compute annual returns on stocks. I wanted to see how bad 2022 was in the larger scheme of things. And it was about, and you can look across time and you can see that it fell. It's not the worst year ever. There have been 5 years where the return on the S&P 500 has been worse than minus 25%, but it was a pretty bad year. In fact, if you look in nominal terms, it was the 7th worst year in the last century for stocks, and the 6th worst year if you think in real returns, which is with inflation eating away. If you think in terms of decades, remember though that while you might bemoan how bad 2022 was, you've had a pretty good run as an investor, right? The last decade, 2011 through 2020, you saw stocks rise 263% in nominal terms, 205% in real terms. It's not the best decade ever. It's the third best decade ever, but nothing to complain about. So in many ways, 2022, you were just giving back some of that ride up that you saw in the previous decade. Easy come, easy go. So it was a bad year for stocks. You obviously knew that already, looking at your portfolio, but kind of reinforces that. Now, of course, started 2023, if I asked you what's coming, you could say 2022 was a terrible year. But then if I asked you what your expected returns would be, while those might be colored by what's happened in the past, your expected returns should always reflect what you need to make, not what you made in the past. So it would be irrational of you to settle for expected returns which are negative. So if you said 2022 is minus 18%, I think the next year is also going to be minus 18%, then you shouldn't be holding stocks. So one of the questions you always face when you value equities, when you think about corporate finance is, hey, it's a bad year, but what's my expected return going forward? What can I make on stocks? Now, of course, when you think about what you need to make on stocks, you start with what you can make on something risk-free. In this case, let's say T-bonds, and you add a risk premium to it, an equity risk premium. As many of you know, I'm kind of obsessed with this word and estimating it. But what is that equity risk premium? I know I was taught how to estimate that equity risk premium by looking at the past. And I'm sure many of you were taught the same way. Look at historical risk premiums. And at the start of 2023, I estimated what that historical risk premium would have been in the US going back as long as I can. So let's be very clear on what this is. This is what investors have historically earned as a premium for investing in stocks over something risk-free. I use two measures of risk-free, T-bonds and T-bills, and I compute the historical risk premium by looking at what the return on stocks is versus the return on T-bonds. So as an example, if over the last 40 years you made 9% investing in stocks and 4% investing in T-bonds, 9 minus 4 is 5%. That's your historical equity risk premium. If you notice in this table, I estimate 12 different estimates of the historical premium. See, how come 12? Because I took 3 slices of history, one going all the way back to 1928, 75 years of history. That's my starting point. One going back to 1973, that's 50 years of history, and one going back to 2013, which is 10 years of history. So 3 different slices of history. I estimated the premium against both T-bonds, which are 10-year bonds, and T-bills. You're saying why 10-year bonds? Because the 10-year bond is the only treasury which has a continuous history from 1928 through 2022. 30-year bonds have come and gone, so I'm going to stay with the 10-year bond. I also looked at the 3-month T-bill. The premiums are different depending on whether you use T-bonds and T-bills. I even computed averages differently. This sounds like inside statistics, but if you ask me what the risk premium is, one way I can do it is by computing an arithmetic average at 100 years of returns and then divide by 100, or a geometric average return, which is a compounded return. Well, geometric averages really are much more meaningful, but the numbers are different. So the premium ranges anywhere from 4% to 13%, depending on how you slice and dice history, whether you use T-bonds and T-bills, or whether you use arithmetic and geometric averages. I don't like historical premiums, and one reason is this table. You know why? Because we know bias permeates much of what we do in valuation and corporate finance. And if you're biased, you're going to find a number on this table that best reflects your bias. So if you want to value a company and show me it's a high value, you know which number you're going to latch on to this table? You're going to go with the 4.12%. Lower premiums, push down the cost of equity, push down discount rates, push up value. You want to show me the same stock is overvalued, I give you this table, you go with the highest number. It's a recipe for mischief to have this entire table. As many of you know, this data used to be, or a version of this data used to be available from a service called Ibbotson Associates. And you have to give Roger Ibbotson credit for making this part of the popular wisdom. He created a table. It wasn't rocket science. He looked at returns on stocks, bonds, and bills over time, and he computed historical premiums. That data got sold to Duff & Phelps, and now, of course, Duff & Phelps is Kroll, and you have this 1,000-page book of equity risk premiums where they've taken the historical data and sliced it and diced it. And not only do they give you historical risk premiums to stocks, they also give you small cap premiums, they have decile premiums. But here's what I want you to think about every time you look at a number in that book or in this table. Remember statistics? If I gave you 100 years of data and I say compute an average and you did, if this were a statistics class, I'd also ask you, what's the standard error, right? Because an average is not a fact, it's an estimate. See the numbers below the equity risk premiums in this table? You know, those are the standard errors and estimates. Think about what I've just said. If I told you the historical risk premium in the US is 5.06%, that looks amazingly precise, right? Second decimal point. What I forgot to mention was the standard error in that number is 2.15%. You know what that means. In statistical terms, the true equity risk premium can be anywhere from 1 to 9%. That's a lot of room to run. I have not used a historical equity risk premium probably 30 years in valuation, and one reason is this table. Now, I'll give you an alternative in a minute, and the alternative is to do a forward-looking dynamic premium. Let me talk about the meaning of the two words. The historical premium is static. What does that mean? If I compute that premium at the start of 2023, it's not going to change to 2023 no matter what happens in the market. It's not dynamic. And it's backward looking because I'm looking at what I would have earned last 50 years, last 100 years. My version of an equity risk premium is forward looking. What does that mean? I take the level of the index at the start of 2023, that was at 3,008, so that's the S&P 500. I project out expected cash flows, and cash flows on US stocks can take two forms, dividends and buybacks. And if you take a look at the last 12 months, you can see about 2/3 of the cash flows in US stocks have taken the form of buybacks. I project out these cash flows based upon analyst estimates of growth. And we can take issue with analysts. They overestimate earnings, they underestimate earnings, but it doesn't matter because I want expectations of earnings to be able to back out my risk premium. I get expected cash flows, and then I solve for the discount rate that makes the present value of my cash flows equal to the level of the index. Think of it as an IRR for stocks. It's like a yield to maturity for stocks. That number at the start of 2023 was 9.82%. Put simply, here's the way to think about it. Given how stocks were priced at the start of 2023 and expected cash flows going forward, the expected return on stocks is 9.82%. You subtract out the T-bond rate, which was 3.88%. The implied equity risk premium, implied because I'm implying it from the index, was 5.94%. That number is the number that I want you to track because in this table, I've looked at what that number looks like over time. Just look at the last 2 years. At the start of 2022, not that long ago, right? This is 15 months ago. Start of 2022, the equity risk premium, doing the same approach that I just computed, was 4.24% on top of a risk-free rate of 1.51%. At the start of 2022, the expected return in stocks was 5.75%. That's close to a historic low. You can see in this graph, that's about as low as it's got. At the start of 2023, 1 year later, the expected return is up to 9.82%. That's a jump of more than 4% in 1 year. That's the largest 1 year increase in the expected return because I've been computing these numbers over time, and I've reverse engineered it to compute it from 1960. It's the biggest single year jump in the expected return. Now, part of you is saying, who cares? Remember, as your expected return goes up, you're paying less for stocks, or you can't pay as much for stocks because you're demanding a higher return. From an investor's perspective, that's the twin to why stocks went down so much. The stocks now are priced lower, the expected return has gone up. From a company perspective, there's another reading. Remember, this expected return on stocks is the cost of equity for companies. And if you believe that graph, the cost of equity for companies, for the median company in US dollar terms, has gone up from 5.75% to 9.82%. That's a 1 year jump in the cost of equity. If that still doesn't register, here's another way to think about what happened during 2022. Let's say in January 2022, you found a project that earned a 7% return on equity. Remember, your cost of equity is 5.75%, right? You'd have taken the project. 1 year later, you have massive regrets about what you just did, because now the cost of equity has jumped to 9.82%, and that project that looked good at the start of 2022 is looking awful right now. Nothing you can do about it. Buyer's remorse is not going to bring it back, but there's a lot of buyer's remorse around the world as you look at the cost of equities going up. So one of the things I do at the start of every year is I compute the cost of equity, and that's a way to think about this. For every company, I compute it on average by industry group. Here's the sector averages. The median cost of equity for a company in the US was 10.67%, but you can see the variation across sectors. Across every sector, costs of equities were up across stocks. And the reason, of course, was higher risk-free rates plus higher equity risk premiums is a potent mix when you think about what it does for stocks. So collectively, stocks have had an awful year over 2022. Now, I'm not a market timer, so I don't usually act on valuing the market, but I do at the start of every year try to come up with a market valuation reflecting market consensus views. So at the start of 2023, everybody was convinced that stocks were dying, we should all run for the hills. So I wanted to see whether stocks were mispriced at the 38, 39.5 that they were trading at. So I did a intrinsic value for the S&P 500. You see, what does that even mean? Well, you know how you do an intrinsic value for a stock. You project out the expected cash flows and you discount them back at a required rate of return. Well, I did that here. So I have my expected cash flows. I came up with what I thought was a reasonable equity risk premium, about 5% based on the average since 2008. I used the risk-free rate as of the date that I did this, and the value that I got for the index was 39.72. In other words, it looked slightly undervalued, which put me at odds with most of the people looking at the market at the start of the year. But based on the cash flows in the index, I concluded, you know what? Stocks look okay. Now, of course, there are two big wildcards for 2023. These wildcards were around in 2022 and they burned me. The two wildcards is what's going to happen to inflation in 2023. Excuse me. And the other is, will the economy go into recession? So here's what I did. I created a box where essentially I looked at four scenarios. Let's start with the most benign scenario. Inflation quickly subsides to pre-pandemic levels and there's no recession. What does that mean? In my previous table, that means I don't get the earnings drop that comes from a recession and risk-free rates come down quickly. I have an estimated value for the index of 4,311. The worst case scenario, inflation stays high, there's a steep recession, the index could drop to 3,200. So I'm not arguing that you should just buy stocks blindly, but I'm arguing that that index level reflects different scenarios. I'm okay with where stocks are at the start of 2023, but inflation and the economy go into a tailspin, all bets are off. because the value has to be recomputed, the index will go down. So with equities, it was a bad year. We know why it was a bad year. Inflation went up, pushing up the risk-free rate. And one of the twins that happens when inflation goes up is equity risk premiums went up. You combine the two, the required return on stocks jumped by more than 4%. That pushes down the level of the index. But the big question going forward is are we now in a steady state? And I think until we know how inflation and the economy play out, talking about a steady state is in fact overreaching. So far in 2023, we've had an interesting year, very similar to 2022 in some ways. We had a really good January. It seems like the consensus was, there's a recession, it'll be a mild one, inflation is coming down quickly. We had a really bad February, because by February, the entire story seemed to have changed. There's a recession coming, inflation is not going down. We had a bad first half of March, partly because of the banking crisis, but the banking crisis was triggered by inflation, right? Because SVB's bonds essentially reflected the inflation effect. And then the second half of March and through April, things seem to have subsided again. So right now, and I'm supposed to be on CNBC this Friday, the consensus right now is there's not going to be a recession. Inflation is coming down quickly. But just like last year, I have a feeling that we're on a roller coaster ride and the ride's not done. We're going to get more shocks in inflation, more worries about the economy. So don't be surprised if things turn on a dime. And that's the thing about inflation. And the way I describe inflation is it takes markets are always moody, right? They're good mood, bad mood. What inflation does is it makes markets bipolar. So it takes these mood swings and makes them extreme. So this has always been the problem with letting inflation out of that. If inflation is a genie, letting it out of the bottle, is this almost always follows. So any questions on the equities part of what I just said? So essentially talking about how it's changed cost of equity, equity risk premiums. That's the big story of 2022. And I have a feeling that story will continue to play out through 2023. Okay. We'll get a chance to do a Q&A at the end, so we'll come back to that if you have no. And so incidentally, at the start of the year, you looked across market strategies, and I look at this just for laughs. I'm convinced that market strategies exist to give you just make soothsayers look good. Their predictions are absolutely useless as predictors, but for whatever it's worth, this is what the market strategists at the big investment banks in the US were predicting for the S&P 500. So that's the equity part of the story. But I think the real action, if 2022 was just a bad year for stocks, remember the 7th worst year, 2022 was a calamity for the bond market. It's the worst year in history in the bond market. I know that's saying a lot. Let me back it up. Right? So if you look at 2022, it was a year when we started the year risk-free. The T-bond rate, the 10-year bond rate was at 1.51%, and it soared during 2022. The T-bill rate, which was close to zero, rose above the T-bond rate. The yield curve that was upward sloping became downward sloping. And in the corporate bond market, the analogous variable to equity risk means the default spreads widened. So what does this all mean? Let's start with treasury rates. So in this graph, you're looking at treasury rates from 3-month rates all the way to 30-year rates through 2022. This is 1 year. So the 3-month rate started the year at 0.06%, ended the year at 4.42%. All of a sudden, all those people who've left their cash sitting around in their brokerage account and said, what's the big deal? What am I going to make on the cash? Suddenly discovered that cash can actually be used productively, 4.42%. The 3-month T-bill rate soared by almost 4.36%. Across the board, rates rose. They rose less at the long end of the cycle, but even at the long end of the cycle, there were significant moves. The T-bond rate moved from 1.5% to 3.88%. The 30-year rate moved from 1.9% to 3.97%. But across the board, you saw rates move up. But because short-term rates move so much more than long-term rates, the yield curve became downward sloping. Now, I'm not a great fan of using the yield curve to draw all kinds of strange conclusions about the economy, but there is information in the yield curve, and it went from upward sloping to downward sloping. It was a big year for treasury rates. Now, how did this play out? If you take a 10-year T-bond, you normally think of 10-year T-bonds as pretty safe investments, right? In fact, the old 60-40 recommendation that investors used to get in the US, put 60% of your stocks money in stocks and 40% in bonds, was built on the premise that bonds are less risky than stocks. They don't do as badly as stocks. That might be true most of the time, but not in 2022. Think of what happened to the 10-year T-bond during 2022. The coupon was 1.5%. So let's say you bought that bond with a 1.5% coupon at the start of 2022. It was priced at 100, right? Or 1,000, depending on the bond. During the course of the year, what happened? The 1.52% went to 3.88%. If you take that 1.5% coupon bond, you reprice it at a 3.88% rate, which is what I do in the start of every year when I do my returns. You know what happened to the price of the T-bond? The price of the T-bond dropped by 19.34%. That's mind-boggling. Here you have what's called a safe investment with a 19.34% drop in prices. In fact, if you remember, the equity drop was also about 19%. A 60-40 mix would have given you a combination of two asset classes, both of which dropped by 19%. Weighted average, of course, is going to be minus 19%. In nominal terms, the T-bond return was minus 17.8%, but 2022 was also a year with high inflation. If you incorporate that inflation effect in real terms, the T-bond return in 2022 was minus 23%. How does that put up in history? It's the worst year ever in bond market history. I mean, take a look at this distribution. I mean, typically bonds don't move in double digits. Minus 17.8% nominal return, minus 23% real return. It is by far the worst year in T-bond history. Now you can see why Silicon Valley Bank got into trouble. Remember, Silicon Valley Bank's original sin was mismatching duration, right? They had direct deposits and short-term fixed deposits they invested in long-term T-bonds. Question? That they invested in long-term T-bonds. By itself, you're saying, what's the big deal? T-bonds are safe. Most years they might have, but in 2022, that was the odd year where T-bonds dropped by. Can you imagine taking $1 billion in deposits, putting them in $1 billion in T-bonds, feeling pretty good about what you did? And then you adjust for the 19% drop, and all of a sudden you're in a hole. It's not just Silicon Valley Bank. It's collectively banks across the US have done this. It's estimated that at the start of 2023, there are about $620 billion of these losses still to come, because many of these bonds are held by companies without having to mark to market. There's a special category. Maybe the accounting needs to be revisited on this one, which effectively means that there's a 10-15%. And the reason it was so bad at Silicon Valley Bank is this was a bank that had 60% of its assets in long-term bonds and mortgage-backed securities. So when rates change, the price effect is huge. It's kind of the perfect storm that pushed the bank under. So it's a terrible year for bonds. But here's the other unusual feature. Most years when stocks are down strongly, those 5 big years we had minus 25% or worse returns in stocks, were all years when bond returns were positive. And here's why. Those were crisis years, right? 2008, 2000. Think of what happens to T-bond rates during crisis years. In 2008, stock market, the equity markets are obviously devastated. Stocks are down 20-something, 28%. But T-bond rates went from 4.5% down to less than 2%. Usually in a crisis, T-bond rates decrease. That pushes up returns on T-bonds. What made 2022 so unusual was not only did you have a bad year in stocks, it was accompanied by a bad year in bonds. Why? Inflation. If it sounds like I'm blaming everything on inflation, it is because I am. Inflation changes the dynamics of investing, and that's what made this possible. A bad year for stocks and a bad year in bonds, both driven by the same force, which is inflation. Now, of course, if you ask people, why did rates go up in 2022? In fact, in the aftermath of the Silicon Valley Bank meltdown, there were people who were ready to blame the Fed. It's the Fed's fault. The Fed raised rates. Really? You fall for that nonsense? The Fed was responsible for raising rates? In fact, I've been hearing this for a decade plus, that the Fed sets rates. Why were rates low in the last decade? Because the Fed willed it to be so. QE1, QE2, QE3, who knows, whatever else you throw on the table. That's nonsense. The Fed does not set interest rates. In fact, the only interest rate the Fed sets is the Fed funds rate. It doesn't set the mortgage rate, it doesn't set treasury rates. It's a fiction sold to you by Fed watchers and CNBC. Saying, but why were rates low over the last decade? I have a very simple response. Every year I compute what's called an intrinsic risk-free rate. To understand what I'm going to do, I'm going to take you back to your econ class and remind you of an equation called the Fisher equation. You know, the Fisher equation says a nominal interest rate is composed of expected inflation and expected real interest rate. That's a simple breakdown. Over the long term, the expected real interest rate converges on expected real growth. So what I do is I take the inflation rate each year, that's a red part of the column, and I add on the real growth rate, GDP growth rate in that year. So if your inflation rate is 3%, your GDP growth is 2%, 3 plus 2 is 5%, that's my intrinsic risk-free rate. So that's what the columns give you. See the black line? That's the actual T-bond rate. Let me ask you a question. Do the two move together? Yeah, most of the time. Let me ask you another question. Why were rates low in the last decade? Because inflation was low and real growth was anemic. You add low plus low, you get low. It wasn't the Fed that kept rates low in the last decade. They contributed, but the fact that inflation was low and real growth was low. And of course, we're back to Fed watching, right? You're saying 2022, we'll come back to it, but let's face it, the biggest reason interest rates rose in 2022 was because inflation came back into the game. After a decade, and remember the last decade was the lowest decade for inflation in the last century in the US. The average inflation rate was 1.7%, lowest ever. Inflation came back into the game. When inflation came back into the game, interest rates went up. In this graph, what I've done is I've taken the T-bond rate and I've taken the TIPS rate. You're saying, what does that tell me? You take the difference between the two, that's your expected inflation number. The expected inflation number in the US reflected a surge from what it was in 2021 and 2022, and it had dropped to close to zero. Inflation is back and interest rates went up. But I can hear you saying, if you've been listening to too much CNBC, but the Fed raised rates. Really? You want to blame this on the Fed? What I have in this graph is actually the 10-year T-bond rate. That's the green line, the T-bill rate. And then I have the Fed funds rate. Now you tell me whether Fed funds rates going up is pushing up the T-bill rate, because that's the usual argument made, or whether the T-bill rate going up is pushing up the Fed funds rate. I might be seeing things, but it seems to me that by the time the Fed acts, the markets have already moved. I tell the story of this rooster called Chanticleer. It's a story that's been around forever. And Chanticleer lives in a barnyard, and all of the other creatures in the barnyard, the animals, the roosters, everybody else in the barnyard thinks that Chanticleer is the most amazing. They crown him king. You know why? Because they notice that when he crows, the sun seems to come up. So after a while, they conclude that Chanticleer crowing is what makes the sun come up. And then Chanticleer makes his fatal mistake. He forgets to turn on the alarm on his iPhone or whatever he uses to wake up. He sleeps through the sunrise. And you know what happens, right? The sun comes up anyway, and Chanticleer has not crowed. And the other barnyard animals said, look, it wasn't your crowing that brought the sun up. You crowed because the sun came up. The Fed is more follower than leader. It's more Chanticleer than you realize. It's not the Fed raising rates that made the T-bill rate go up. It was rising inflation. In fact, what's the Fed been doing this year? It's been raising rates, right? What's happened to treasury rates this year? They've gone down. So how do I explain that? Stop talking about the Fed. My grandson's favorite movie is Encanto. And his favorite song is Let's Not Talk About Bruno. Can we adapt that song for the Fed? Let's stop talking about the Fed. It's unhealthy. It makes people do things to their portfolios. And it gives every portfolio manager an excuse. Why did you do badly? The Fed made me do it. Let's stop using the Fed as an excuse, because they're not the ones driving rates here. So the Fed fixation has to go. and it's not healthy. It's not good for your investing. No. Now, turning to the corporate bond market, everything that happened to treasury rates kind of underlies the corporate bond market, because when the T-bond rate goes from 1.5 to 3.9%, it's like a rising tide. It pushes up corporate bond rates. But on top of the T-bond rate, you have a default spread. What does that measure? It's the price of risk in the bond market. Just as the equity risk premium is the price of risk in the stock market. You know what those default spreads did during 2022? They soared. Why? For the same, you're going to hear a familiar culprit. It was inflation. You're saying, why would inflation affect default spreads? Because higher inflation goes with higher uncertainty about inflation, and higher uncertainty about inflation increases risk across the board. So default spreads widened across the board, more so for lower rated bonds and higher rated bonds, but every single ratings class you saw default spreads go up. What does that mean? If I take a corporate bond, remember that 2022 was the worst year ever for the T-bond? I took a BBB, an investment grade corporate bond. I did exactly the same computation of what the return would have been in 2022. And guess what? It was a terrible year for corporate bonds as well. You expected to see it, but it's worse than the T-bond, because in addition to the rates going up, the T-bond rate going up, you now have higher default spread. Minus 24% on a nominal basis, minus 31% on a real basis. Again, worst ever year for corporate bonds. Now, if you bring together the higher equity risk premiums and the higher default spreads, you know where they show up for companies, right? The higher equity risk premiums show up as higher costs of equity. The higher default spreads show up as higher costs of debt. Underlying all of this is a higher T-bond rate. The cost of capital for companies reflected that. The median cost of capital for a global company was 10.6% in US dollar terms. If you have a different currency, just add on the differential inflation. The median cost of capital for a US company was 9.6%. And just to show you how consequential the year was, I do this graph at the start of every year. This is what it looked like 1 year ago. Take a look at the median cost of capital for a global company. 1 year ago, it was 6.3%. Now it's 10.6%. Median cost of capital for US company, 5.8%. Now 9.6%. Biggest single year increase in cost of capital ever. And this will play out in every aspect of corporate finance. At the start of 2022, all you had to do in a project was earn higher than your cost of capital, which is 5.6, 5.7%. Now you got to make 9.6, 10, 10.5%. Investments you'll have a harder time finding good investments. In financing, the mix of debt and equity is going to be affected by how equity risk premiums and default spreads will move. But here's the bottom line. If your cost of capital goes up and your investment returns don't go up, in the same proportion, you're going to have a lot more cash to return. So you're going to see companies sitting on cash because they can't find investments, or in some cases, returning that cash. So you ask me, what will interest rates do in 2023? I'm going to go back to the two wildcards. It depends on what happens to inflation and the economy. Again, let's take the best case and worst, most benign scenario. Inflation subsides to pre-pandemic levels. There's no recession. You're going to see risk-free, the T-bond rate continue to drop. It's already dropped this year from 3.9% to about 3.3 or 3.4%. It'll keep dropping. Most malignant scenario is inflation stays high. You have a steep recession. You could have a stagflation, because you're going to see T-bond rates rise because that higher inflation is going to act like a ballast. So as you watch 2023, keep your eye on inflation, because it's going to drive both the stock and the bond market. One final component of this presentation, and then I'll be done. I mean, obviously, I've been very US-centric in my discussion so far. For an audience, it's primarily probably European. Okay? So I'm going to globalize the discussion. I'm a little, one of the things I have to deal with, because I do valuation and that's what I teach, that's what I do. I have to deal with country risk. And so when you think about investing in a country other than yours, you're saying, well, what does the risk look like? And the reality is, even if you invest in companies that are only domestic companies, to the degree that they do business outside your market, they're exposed to country risk. And if you think about what drives that country risk, I mean, in generic terms, there are four big forces driving country risk. The first is political structure, right? And it plays out in very strange ways. Sometimes dictatorships have less country risk than democracies, but they have a different kind of risk, more discontinuous risk. A regime change can create a significant change in risk. How exposed are you to war and violence? That pushes up country risk. Corruption. More corruption there is, the more country risk. And finally, the more loosely legal and property rights are enforced, the more country risk you face. Unfortunately, those four variables are highly correlated with each other. In other words, countries with a lot of corruption tend to also have war and violence, have politically unstable structures, and don't pay much heed to legal and property rights, and that shows up in country risk. Now, of course, to measure country risk, you also think about where your country falls in the life cycle. For those of you who track my writings, you know that I'm obsessed with corporate life cycles. You tell me where a company is in the life cycle, I can pretty much draw out what it means for investing, financing, and dividend policy. You can think of countries falling in the life cycle. Young countries that are growing, will have more country risk than mature countries. And mature countries will have less country risk than countries going into decline because you face a different kind of risk. So you can think of countries like Japan being countries in decline. I'm not casting aspersions on Japan. It's really a fact of demographics. As populations age, you're going to move from mature to declining. Mature countries tend to be the safest, and then young countries, even if they have lots of potential, tend to go with a lot of risk. The question is, how do we measure that risk? And one proxy we can use is default spreads, and I'll come back and talk about it. But just as a brief stopover, remember I showed you what happened to risk-free rates in the US dollar? Well, in this table, I have risk-free rates in different currencies at the start of 2023. So the way I get these risk-free rates is I start with a government bond rate. And if it's a country like Switzerland, I stop because that government bond rate is the risk-free rate. But if it's a country like Turkey, I have to adjust that government bond rate for potential default risk. So the red portion of this graph are the default spreads for countries. The blue portion is the risk-free rate by currency. So if you take the Zambian kwacha, the risk-free rate is more than 15%. You take the Japanese yen, the risk-free rate is negative. In fact, it's the only currency left with a negative risk-free rate. There used to be at least 4 at the start of 2022. You're saying, why do risk-free rates vary across currencies? The answer is differences in inflation. High inflation currencies have high risk-free rates, low inflation currencies have low risk-free rates, and deflationary currencies could potentially have negative risk-free rates. So risk-free rates did have a tumultuous 2023, but we start 2022, but we start 2023 at those levels. Now, for those of you who track my data, I estimate equity risk premiums by country, and it's not rocket science. It's actually a pretty transparent process where I start with the implied premium for the US, and I showed you that calculation, 5.94% at the start of 2023. I look up a default spread, either from the sovereign CDS market or based on your rating, and I scale up that spread for the fact that equities are a little more volatile. At the start of 2023, that scaling factor was 1.41. So as an example, I start with 5.94%. If you're a country with a default spread of 2%, I take the 2%, multiply by 1.41, I get 2.82%. Add that to 5.94%. I get an equity risk premium for your country. At the start of 2023, here's what equity risk premiums look like around the world. Some are huge, right? So these are equity risk premiums by country, and they reflect the differences in ratings across countries. Some countries like Russia had a very, very big move in 2022. And I don't have to insult you by telling you what happened. But basically, you can see equity risk premiums moved a lot across the world. In fact, I've had a lot of emails from people who use my country risk premiums, and they look at the equity risk premiums at the start of 2023 and they're surprised. I got a Hungarian analyst email me a couple of weeks ago. He said, look, I was using 7-point-something%, which is your equity risk premium for Hungary last year. I just looked at your update. It's 9.23%. Why did it jump so much? And I went through the process. I said, look, my starting point last year was the US premium, which is 4.24%. That's now 5.94%. Even if nothing changes, that's a 1.7% extra risk premium. And on top of that, remember what we said about default spreads widening during 2022. That's adding more boost to your equity risk premium. Every country in this table has a much higher equity risk premium than it did at the start of 2022. And riskier countries saw a much bigger increase than safer countries. Inflation is not fair. It, in fact, has a much bigger impact on the riskiest among us, the ones least able to bear the burden. And that's why inflation is the most inequitable macro factor of all, because it makes the poor even poorer. It makes the risky even riskier. And that's never a good outcome. Now, of course, if you have an individual company, you might say, well, what's my exposure to the country risk? I know the lazy way is to say every Turkish company is equally exposed to Turkish country risk, and every US company is only US country risk, which I think is absurd. Your risk exposure doesn't come from where you're incorporated. That's a very lazy way to compute risk premiums. It comes from where you do business. Of course, we can debate whether you measure how you do business with the revenues or production. But as you know, when I value companies, I compute a weighted average equity risk premium for a company based on where it does business. What does that mean? If I value Coca-Cola, you won't see the US equity risk premium. You see a weighted average of the 72 countries that Coca-Cola operates in as my equity risk premium. It's good practice, and I would reinforce that. And if you use that practice, remember what I said about cost of capital going up? Given how much equity risk premiums went up even more in risky countries, for those companies that have exposures in risky countries, the jump in the cost of capital is even greater. One final slide, then I'll wrap up. Of course, after a year like 2022, what do? We turn to governments for help. You know what? These were the same governments that got us into the inflation mess we're in. What makes you think they're going to save you? And how can they save you? In fact, anything governments do to try to save you from the consequences of inflation often have even worse consequences. Less is more. So as you look at country risk and equity risk premiums, you should have to play out. Let's summarize. 2022 was a big year and a bad year for stocks, for bonds, in fact, for almost every asset class, it was a bad year. Gold held its own, but that's what you'd expect, right? It's a collectible. Crypto did not, which makes you question whether can be the new collectible, because I've described Bitcoin as the millennial gold because that's a hope that millennials have. It'll behave like gold. It didn't. In 2022, it behaved very badly. It behaved like a very risky financial asset. We'll see what 2023 brings, but it's going to be an interesting year. And as I said, keep your eyes on inflation and the economy, because that's going to determine in large part how stocks, bonds, and every other asset class play out for the rest of the year. That's it. I'm going to open up for questions, but thank you for listening. Yeah. Caetano says, but the T-bonds are safe as long as... They're not safe. You get what was promised you, but the promise was 1.51% a year. You collect the 1.51%, but let's say inflation is 20%. You got what you were promised, right? But remember, the power of money is its power to consume. The coupons you get might be guaranteed, but the consumption you can buy with those coupons are not. When inflation is high, the nominal return might be guaranteed, but the real return is not. So in real return terms, you're going to feel awful, even if you hold to maturity, because you're not making enough money to cover inflation. Sachin, stop. What do you mean reduce? Who's reducing them? You're saying the market? The answer is the Fed. It's, let's face it, the Fed has nothing to do with this, right? It's market. If you're saying interest rates went down too much in 2020, 21, maybe people, and this is what happens when you have a decade of low inflation, people forget inflation. In fact, I remember people in 2021 saying, inflation is dead, we've killed it. We found a permanent solution to it. So if that's what you mean by rates were reduced, people were being too benign about inflation, then absolutely, I agree with you. And I think we laid the foundations for where we're in by being too casual about inflation. I remember writing a post at the start of 2021. Remember when people in the Fed and Janet Yellen were talking about inflation being transitory and they were talking about supply chains? I said, look, act on the presumption that it's not transitory, because the risk of it coming back is just too dangerous, it's too high. But nobody listened. By the time they woke up, it was too late. Inflation was out of the bottle. Look how desperate the Fed is now. They could have avoided this if they'd acted earlier. So if that's your point, I agree with you entirely. Yeah. If you think inflation is going to go down, Bhavisha, you're absolutely right. You should buy any kind of bond. Why just, the only problem is, how do you know inflation is going to go down? It's not guaranteed. Don't buy the narrative that inflation will always go back down to 2%. In the early 70s, people thought that inflation conquered at 4%, but it went to 5%. They thought they'd conquered it at 5%, it went to 6%. And that's part of the problem with inflation, is once the genie's out of the bottle, you really don't know which direction inflation is going. But if you have a strong point of view that inflation is going to go down in the future, absolutely. But it's not just bonds. Every financial asset class is going to benefit if inflation decreases. Bonds, it's direct, but everything else will benefit as well. You know what, Ross? It's not just US banks, because rates rose. The euro 10-year rate went from 0% to 2%. So this is a phenomenon that's playing out not just in the US, it's playing out in Europe. It's also playing out in much of the rest of the world. Japanese rates went from -2% to 0%, right? So this is these unrealized losses. By itself, it's not catastrophic. And here's why. The typical US bank has about 20% of its money in long-term bonds. You know how much SVB had in long-term bonds? 60%. So it's almost a unique circumstance that caused the tip over. JP Morgan is not going to be brought down by this. Neither. What it's going to do is not so much to have an effect on the equity risk premium. That could happen if you had a banking crisis. But then, remember, it's not just the US equity risk premium, it's a global crisis. If you don't have a banking crisis, what this will do is shift power away from smaller banks, market share away from smaller banks to larger banks. Why? Because depositors get scared. They're going to move their money from smaller regional banks to the JP Morgans. In a strange way, this makes those larger banks more powerful, even if they have unrealized losses, because as long as the deposits keep coming in, you don't have to realize those losses. How will the inflation recession combo? The answer is obvious. If you have high inflation and you have a recession, you're going to have a tough time finding a job and getting pay that matches up to inflation. So you better hope, if you're a new job seeker, that you're looking at a benign scenario rather than a malignant one. Because I came into markets in the early 80s when Paul Volcker was fighting stagflation. And trust me, it was not a good time to be looking for a job. It was not a good time to even have a job because your pay didn't keep up with inflation. Nobody does well when you have a combination of high inflation and a recession. So that's the combo. You're going to hope for when inflation comes down, economy stays strong. You might even be okay if inflation stays high and the economy stays strong, because then at least your wages will keep up with inflation. Well, I think you should stop trying, Rahul, because mean reversion is just market timing. That's just a fancy word for market timing. So when we talk about mean reversion in interest rates, I think somebody mentioned buying long-term bonds and saying there'll be mean reversion, inflation is going to go down. The problem with mean reversion is it works as long as there aren't any structural breaks. And I think in 2008 and perhaps even in 2022, you saw some structural breaks. So I would say just take the macro numbers at what they are, I'm a stock picker, so I'm going to find good companies, and I'm going to not bet on interest rates or inflation to make that, because those are macro bets, and I'm not a good macro better. So my bottom line on mean reversion is, stop building an entire investment strategy around mean reversion. We've had a century of US portfolio managers. That's all they do is mean reversion, right? Low PE stocks revert back to the mean. Buy bonds when interest rates are high, hope rates go down. It's lazy and it's unlikely to give you long-term returns because you're bringing nothing to the table. If you bring nothing to the table, you're going to take nothing away. How much is the valuation of a stock affected? You're off by one. Why were you off by 1% in the first place, right? I mean, it depends on, whether you just misestimated or whether the real world and a margin of safety is not an alternative. I mean, I've heard value investors say this. A margin of safety is something you employ after you've done a valuation to cover potential mistakes. But remember, mistakes cut both ways. I don't think a margin of safety accomplishes much more than making you feel more comfortable. And here's a test. If you have a margin of safety that you made up 40% and most of your portfolio is in cash, I would ask you to re-examine your margin of safety. Because what's the point of having a big margin of safety if you never invest? So I've never believed in the margin of safety as doing you much more than giving you that comfort zone to invest in. And it's not that the equity risk premium is off by 1%, right? My bigger worry is my revenues are off by 10%. My margins are off by 5%. The discount rate is not where the action is in evaluation. It's in the cash flows. So if you're worried about something, stop worrying about the discount rate being off and start worrying about your cash flows being off. No. Not if you've defined the risk-free rate. If your definition of something is risk-free, how can any corporation have a rate lower than the risk-free rate? You can't print money. So the answer is no. It can be lower than the government bond rate because government bond rates are not always risk-free. You know why? Because it's psychological, right? So if inflation jumps out, and I'll give you an example. I live in San Diego. There's a Mexican restaurant down the block. For 10 years, the price of a burrito stayed constant. It was, I think, $7.95 for 10 years. And inflation came about, and the guy raised the price from $7.95 to $9.95. The first time he did it, or $8.95. Remember, he had big signs. He would explain to people, look, the costs are going up. I have to pass the inflation on. It was the first time. And 3 weeks later, when it went from $8.95 to $9.95, the guy hadn't spent much less time explaining the difference. Now he routinely raises the prices by $1 every 6 months. And people expect it. There's no explanation. In other words, our brains get patterned based on inflation. So when you go into your boss and ask for a salary pay increase, you build in the fact that people were asking 5%. Inflation was 7% last year. The problem with inflation is get patterned to behavior, and breaking that behavior requires some serious shocks. It took Paul Volcker 4 years in a very severe recession to break that mindset. It's painful. Yeah, that's why it's like a genie in the bottle. Getting it back in the bottle is going to be a real pain because people's mindsets have changed. I'll tell you, anytime a president fights a central bank, it's bad news. Take a look at what's happened in Turkey. The Turkish president is convinced that rates are high in Turkish lira because the Turkish central bank is setting them so high. So you know what he does? He puts pressure on the Turkish central bank to lower rates. But the reason Turkish rates are high is because inflation is high. The Turkish central bank lowers rates. Guess what happens to expectations of inflation? They go up even more. It's like watching insanity in action. Because the Turkish central bank lowers rates, the rates go up, the Turkish president blames the banks, and then they lower rates even more, the rates go up even more. It's not a good strategy. But lest you think this is just about Brazil and Turkey, it's happening in the US as well, right? Everybody's convinced that Jerome Powell is responsible for the Silicon Valley Bank blow up. Come on. So you know what they want the Fed to do? Take your eye off inflation, lower rates. And you know what will happen if the Fed comes back? I'll make a prediction. If the Fed comes back on the next meeting and says, we're going to lower the Fed funds rate by 25 basis points, the T-bond rate will go to 5%. Why? Because people said central bank no longer cares about inflation. So I don't think it's a good idea for any government to fight its own central bank. And this has nothing to do with Lula or Bolsonaro or anybody else. It's you made a fatal mistake in terms of, and Brazil should know better, right? I mean, Brazil's had inflation. They know what inflation can do to an economy, to psyches. You shouldn't be messing with this. But who am I to be giving out political advice? It's not a good idea. No. How can you hedge against interest rates rising? You're doing analysis in dollars. What difference does it make that you're in 15 geographies and country risk premiums went up in every single country you're in? You can't hedge that risk when it's macro and it's all in one direction. You know what kinds of risk you hedge if you're in 15 countries and some countries had something happen which is country specific. You're in Sri Lanka and it blew up, but you're also in, let's say, Bangladesh and it did much better. Maybe you can get an averaging out. You can't average out what happened in 2022. It cut across the board. You know what, Brian, you know what crypto needs to do? It needs to get rid of the people who are in charge of it, because they're not interested in building a currency. They're more interested in creating a trading instrument on which they can make money. In fact, you ask people about Bitcoin. What's the biggest sales pitch for Bitcoin? Look at how much money I could have made on Bitcoin over the last decade. Terrible argument for a currency, right? You know what I'd like them to talk about is what they're doing with Bitcoin to make it easier to use in transactions. And what makes it easier to use in transactions is to make it more stable. I don't want a currency that goes from 60,000 to 15,000 back to 30,000. How, as a shopkeeper, am I going to price things if you keep moving on me? So I think what you need to do is actually build a cryptocurrency that's meant to be a currency rather than a speculative instrument. The only problem is every single crypto has become a speculative investment. That's all people care about. How much money can I make buying and selling Bitcoin, not how well can I use Bitcoin to buy things like my coffee, my house, my car service. It's not healthy when everything is built around speculation and what the price is doing. But that's basically, unfortunately, where we are with cryptos. And, let's face it, 3 months. So crypto goes up and down. So it's not an asset class. So first, don't compare it to an asset class. It's a currency or a collectible. So I don't think what it has done this year is, in fact, what it's done this year makes it an even worse currency. Because you started the year at 15,000, you're now at 30,000. That's not an advertisement for a stable currency, which is, you need stability for a currency.
Well, Aswad, thank you so much for spending time with us, thinking through some of the latest developments and the ones from last year and previous decades even, right? So those of you who remember, it's not all new at the end of the day, right? But maybe in a different context. So thank you very much also for answering all the questions, and there had to be one cryptocurrency question, right? I mean, there always has to be one. So good luck for those of you that are into crypto, because you may need it, right? And for anyone who's interested in continuing the discussion or deep dive refresh on any of the valuation asset techniques and things, you always hear something new in what you share, Aswad, regardless of how long one has been around in financial modeling investment. And there's a QR code also for a discount for the training if people are interested in this. But anyway, thank you so much for joining us. And also, for those of you who are into M&A, there's some M&A trainings, hopefully making M&A work in a much better way. So that's what we're trying to do, from strategy, due diligence, valuation, to integration and separation. If you're interested in that, check it out. Would be glad to have you. And then everybody have a good night, a good afternoon, a good morning. and hope to see you soon again. Thank you.